Okay, Alpha Hunters. Hopefully you're having a very not tubular, terrific Thursday. And we are seeing the market have some pretty good price action today, mostly due from a gap up, but we got plenty to kind of talk about. Yesterday, the Fed, you could say, shocked half the market. It didn't shock half the market, I guess, with 50 basis point cut that we got yesterday afternoon. So, yeah, we did get Fed interest rate decision that did move from 5.5% down to 5%. So the forecast was mostly calling for 5.25. Here over the past few days, it's radically, drastically risen. The odds of it rose to maybe a 50 basis point cut down to 5%, and that's what we wound up getting. I was kind of surprised I didn't really see the Fed needed to, right? Supposedly everything's still going pretty good. Well, not entirely, right? We're not really seeing great response from declining yields over the past couple months, right? We're not seeing like housing kind of pick up like the way it should. So it is an interesting dynamic, but they did do a 50 basis point cut. You can see we did get pretty good volatility there. We got a quick spike yesterday. And that was kind of the talk going into the Fed day, FOMC day, on if we did get a 50 point basis spike, the market would probably really like that initially, look for the sell. That is exactly what we wound up getting. We got the spike, and we were very choppy there for the rest of the day, kind of just sold down. The interesting thing is going to be what happens here over the next few days. We had a huge gap up on the market Thursday. So we gapped up roughly, 1.7% thereabouts on the SPY. Pulled back there for the first 25, pushed there for the second half of that first hour or so. And we've been pulling back here a little bit here over the past 30 minutes. The interesting dynamic is going to be over the next few days. I would still be leaning towards, I'm going to pull it back, right? We've already seen interest rates. I'm going to go back to this a little bit. We've already seen interest rates kind of pull back quite substantially over the past 4 months or so, ever since the end of April. And we can take a look at that when we get to the yields. But we're not seeing the things that should respond for like demand side, the demand side part of the economy that should uptick from declining yields and interest rates. We're not seeing those things tick higher as yields drop, right? Like, pending home sales, auto loans and all that, car sales, all that kind of stuff. So I understand why they did 50 basis points, because you're not seeing the relationship kind of take hold as you would expect it to with a decline in yields, even though, they weren't cutting interest rates yet until yesterday. But anyway, that's just kind of my thoughts. I would rather be pulling out of equities, especially like some of the best performing equities. Anyways, here's a look at the Qs. Currently up 2.5%. Huge gap up here on the Qs. 2.4% of a gap up there on the Qs. Looking pretty good. We'll take a look at that on the daily picture. Also a huge gap up there on the IWM, up 1.5%. The DIA, nice huge gap up here, up currently 1%. RSP currently up about 1%. Nice huge gap up there as well. But you see a lot of these kind of got hit with that whole quick sell down there to kind of start the day. RSP, all-time highs this morning on the initial gap up. Okay. DIA, also all-time highs on that gap up as well. IWM, obviously not even close. Didn't even take out yesterday's quick pop there in the afternoon kind of time period from the Fed interest rate decision. So not quite taking that out. All right. Qs is the one that looks like maybe some huge life gonna come from this, but it is hugely still underperformed from that peak that it put in back in July. And with how much everything else continues to push into all-time high areas, yeah, it's just not one that I'm like, yeah, I could see us continuing to push higher. I mean, I could absolutely see us continue to go higher, right? Because the Qs still have one heck of an open gap all the way back from mid-July. So I mean, we can go on a little bit of a run here. Maybe come fill this gap that we had. I mean, as you know, I mean, anything as we go higher, continue to go higher across the markets. I mean, we just have this huge switch of rotation out of big tech over the past few months and into the other areas of the stock market, especially very apparent here on the SPY, with the SPY still making all-time highs. That has been doing every day so far this week. So that's just kind of where I would be pulling back on some things that have performed very well over the past couple of years. Maybe even really good through the month of like June, maybe in the beginning of July, stuff like that. That's just kind of my perspective. I like utilities. I just have a hard time believing we're not going to see increase in energy demand push utilities higher. So I also like precious metals, gold. I mean, gold all year has been looking good. It's kind of hard to believe that gold won't do well in any environment. So that to me kind of seems like a safe spot. And whether we do have an economic contraction or not, so I think gold would be pretty good. The other one is going to treasury yields or treasury bonds and just buying 3 or 6 months, and then once they mature, just rotate that until you kind of get what you are looking for out of equity markets. Anyways, that's just kind of my perspective. VIX pulled back a little bit today. Makes sense. We're up pretty large. You would think we'd be down more than that, but we are down a somewhat good amount on the VIX. DXY, look at that huge lower wick it threw in yesterday. Came down, snagged that low from August. Huge doji coming in today. So yeah, had a nice little run late last night, and it just pulled back steadily throughout the night into the early morning. And it kind of popped this morning as we got jobs data, which jobs data came in, initial jobs claims actually came in pretty good. So initial jobless claims this morning was expected to come in at 231K, actually dropped off to 219K. So there you go. Looking pretty good there on initial jobless claims for the day. GLD, Gold Trust. Yeah, so gold had really kind of a quick pop there yesterday, and just, I mean, you see how much it got hit, but it's right back to where it was before we got that interest rate decision. But you can see how quickly on the daily it came down, retested right there into that 10 EMA. I mean, it's starting to really gain steam into that bullish direction. Starting to get more separation between some of these moving averages. And yeah, so we're starting to really see this thing maybe accelerate. We'll see. This is precious metals, SLV, that kind of stuff. Gold, SLV, I kind of like that stuff right now. It's just hard to believe, that they won't do okay to really good in any kind of economic situation we got going forward. Yields. All right, yields. So over the past couple days, we've seen yields kind of at least bottom for now, base. Yesterday afternoon, we got the interest rate decision. You can see a quick whipsaw there. Continue higher early this morning. So we'll see what happens by the end of day. But it is an interesting one that we got a 50 basis point cut and yields have gone higher here the best. Roughly about a day so far. I mean, I know yields were kind of dead there for a little while, so maybe they just get into that choppy zone, starting to rest a little bit. We'll see over the next couple of days. Take a look at the monthly, kind of a little bit more longer term. Yeah, I mean, it looks like maybe a little double top coming in. I mean, this is looking at a monthly chart. I just, it's not normal that we go down to this level. I mean, this is like absolutely not normal range at all. So I don't really know if we make it back down to those levels, but yeah. As far as the 10 and 2 inversion, look at that quick little retest of the zero line yesterday, and then bounce. It is moving steadily over the zero into the uninverted area. I guess the only one that, as far as the yield curves, was the 10 versus the 1. And this one was still below the zero line. But you can see how rapidly it is starting to move towards that zero barrier. Yeah, that'll be interesting to see if we get there anytime by the I doubt we get there by the end of the month, but maybe we get there by sometime in October. HYG, high yield corporate bonds, nice gap up there on HYG, looking pretty good. Risky side of bonds is doing all right. LQD, kind of just hanging out, kind of retesting that 10 EMA. Looks okay. Kind of weird upper, not a weird, but pretty good upper wick coming in yesterday on the LQD and the HYG. Although the HYG gapped over its upper wick today. TLT pulling back down. That's kind of an interesting spot. I mean, we didn't make it up to these highs, but we barely broke this high from back in December, and then have come smashing back down, which kind of coincides with barely breaking that low from kind of August kind of time frame as well here on the 10-year yield. Quick look at the 30-year yield. Yeah, the 30-year yield barely broke that kind of low from back in December, and it has quickly, the 30-year has quickly moved higher. While we're here, let's just take a look at the 2-year. 2-year's just kind of flat, not really doing a whole lot. Through a pretty wide doji action yesterday. All right, so taking a look at sector rotation, obviously we're going to have some pretty large swings here, so definitely going to have to take a look at this. Tech is definitely leading the day. Makes sense. Qs are up quite substantially. Discretionary is also doing pretty good, as well as communications. Energies are in line with the market there. Materials are underperforming. Industrials, financials underperforming as well. Healthcare, and real estate, staples, and utilities are all at the lower end of the day. Okay. As far as intraday, so this will be a little bit, I'd say, better understanding of really what's going on today because of the huge gap that we had. But you can see tech and communications outpacing the market so far today. Discretionary is barely, kind of just in line with the market there. Energy's a little bit underperforming there. Materials, financials, industrials, healthcare all underperforming, with staples, utilities, and real estate at the lowest end of the day. Kind of makes sense, as you know, we are seeing yields continue to push higher.